Yesterday was a fairly strong day for the market, nearly green right across the board, and if we look at the fear and greed index, now we are sitting 42, moving into neutral territory very shortly, and it wasn't long ago that we were sitting on the boundary of extreme fear. However, investor sentiment can change very quickly, and with earnings kicking off, this is what we want to take a look at today. Where is the market? How are the companies performing? And there are a number that we want to cover. We're going to look at 3M. We're also going to cover Proctor Gamble as well as Johnson & Johnson that reported today, and some interesting news that we got from Walgreens. Now, Donald Trump was inaugurated just a few days ago, and there is a lot of talk about tariffs, how they're going to affect the wider economy, and whether or not this will cause some issues for the market. And as always, we will keep up to date as and when we hear. Now, the first company we do want to discuss is 3M, which did have a fairly strong earnings. In fact, the shares were up, as we will show you, and they had a 168 EPS, with the market anticipating 166, and their sales of 6 billion was very strong when we compare the market wanted around 5.8 billion. Now, we can also take a look at other impacts of the news, and the first one that we do want to talk about is that their comparable sales, as we can in fact see, did grow by around 2.1% year on year. Something you need to understand with this company, it isn't fast growing, and over the longer term it has struggled to really keep up in line with the 4% inflation rate we continue to talk about, and organic sales alone were up around 1%. Nonetheless, it was very strong in comparison to what the analysts wanted, and we also see that in terms of the full year, they are anticipating around 760 to 790, which is actually in the region of the 778 that the market wants. And ultimately, when it first got released yesterday, the shares were up around 4.5%. If we take a look at the company, well, it is up around 36% over the last year. As noted, over yesterday, it was up around 4%, nearly at 5%. And if you've been a longer term shareholder of this company, quite disappointing, you would be down 14%. In fact, we can see all-time highs. You'd have to go back to around 7 years today at $259, and right now it is trading pretty much at the upper end of the 52-week range, and that is $150. We do, however, notice just one buy rating today with Wall Street, and they do pay a dividend, one that was cut not too long ago and sits around 1.99%. If you want to look at their earnings on a historical basis, well, what we do quite like to see is the 100% track record. They've outperformed over the last 4 quarters, but interesting to note that the next quarter they do expect quite a substantial drop to the EPS, with the subsequent 3 becoming positive. Now, they should give you faith that they can, based on their 100% historical accuracy, hit the 779 estimate for 2025, which means right now their forward PE does sit around 18.9, and if we were to take a look at this in relation to the sector median, it does sit lower. In fact, if you're someone who has been buying now, you would be getting an 11% discount to the overall comparative. However, we do want to point out that the 5-year average PE does sit around 15.5, meaning it is around 22% more expensive than the average. We can also show you that based on dividend yield theory, this does look to be overvalued. Remember, this tells us a company is undervalued when the current yield sits above the 5-year. However, one thing we would say is we're not going to use this today on the basis that they did cut their dividend, so it does seem to be unreasonable. However, what we will pinpoint, and we already just discussed, in terms of comparison against the 5-year average, M does currently trade above that quite significantly, which can be a signal of overvaluation. In terms of looking at the value, this is what we want to do for each of these companies today. We see it at $148, which, as you can see, has been derived from the DCF model. Now, we've put the numbers through the free cash flow year on year, where the average growth looks to be around 1.4% year on year over the period. So we've gone 1% moving forwards. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to the 148, which, as we can see here, in fact, is around the current value, meaning that we believe this company isn't trading at a discount, it's trading right in line with the fair value. Now, we do mention this because typically on the channel, we like to apply a 10% margin of safety. We execute on this if it meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, we'll abide around $133, and we typically keep going till it's near the current trading price, but as it is currently trading right now at its fair value. If you were looking at something like 20%, that would be around the $119 mark. We also noticed Wall Street themselves believe very minimal upside into the end of 2025, $152 price target with upside of 3%. And remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for 3M or any others. We then move on to Walgreens, which was actually down around 10% after the Department of Justice had a lawsuit around opioids. Now we can in fact see the department did announce they are suing the company, claiming that the pharmacist filled millions of prescriptions that actually lacked a legitimate medical purpose and then sought reimbursements from federal health programs. In fact, it was down as much as 13%, quite large news, and if we are to look at this right now, it is trading at a negative 1%, and bear in mind the news broke just yesterday. If we look at over the last week, it is down around 14%. Now over the last year, nothing better, down 50%. Over the last 10 years, down 83%, and it is trading even at the lower end of the 52-week range, yet all three analysts, Wall Street, Seeking Alpha and Quant, do give this a hold. Now we can also mention it does currently offer a yield of around 7.99%, and if we were to take a look at the earnings itself, well, over the last 4 quarters they've actually beaten 3 or 4, 75% track record, but we need to make you aware over the next 4 quarters they're anticipating double-digit decrease to the EPS for every single quarter, with essentially the earnings per share estimate for August 2025 giving it a forward P in the 7 to 7.2 region. If we were to take a look at how that compares against the sector median, well, that is a lot higher. Bearing in mind a lot of risk with this company, it does currently trade at a 56% discount and is around 9% lower than what it typically trades for on a forward P in terms of the 5-year average, and we can show you this again on both a dividend yield perspective where it is at 8.8% versus the 5-year. However, this carries risks amongst itself, which we have covered in other episodes, deeper dives on Walgreens Boots Alliance, and in terms of the forward P, as we mentioned, just marginally lower than the 5-year, which you could argue just in isolation is an undervaluation signal. However, we like to do a lot more than just look at one model. In terms of our intrinsic value, again from the DCF model, you can in fact see here we've used 5%. Maybe you believe that is too optimistic, but based on that right now, we see the intrinsic value at just under $11, meaning very similar to 3M. We don't believe there is a margin of safety. Again, for those that do want to see at 10%, a buy at $9.64, at 20% around $8.57, but with no margin of safety, a very similar story for Wall Street in terms of what we saw with 3M. They see limited of 4% only at the end of 2025. Price target $11.44, and as always, do give us your thoughts in the comments below. Now before we continue, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone on in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 46 undervalued stocks for the month of January. Lots of information, the upside that Wall Street themselves see over the next year, and on top of that, a recently released copy of 43 stocks that Wall Street themselves believe right now have the most upside in the S&P. So click below, you can sign up and read straight away. We then move on to Proctor Gamble that actually released their earnings before the market opened today, and they did beat estimates as they put it down to shoppers buying more household staples. Now if we are to take a look at the actual numbers that they have reported, the EPS, as we can see, a marginal beat, 188 versus 186, and the top line revenue as well, they did have a nice beat, 21.88 versus 21.54, and we also notice the net income comes around 188 per share, which if you do compare it to the same quarter last year, it is higher and came in at $1.40. On top of that, something we did see with other companies, they are struggling to increase it above inflation, but their net sales are up 2%, and if you want to look at just organic revenue, still slightly under than the 4% we would like to see, coming in at 3%. In terms of their volume, so they are saying more of the products, around 1%. That is good to see, but again, something just to bear in mind, and we can clearly see here Procter & Gamble have seen weaker demand for their products after several years of constantly increasing their prices. Ultimately, what this means is that consumers are moving on to cheaper alternatives, but over the next full year, they do anticipate the same earnings per share as what they had guided for earlier, around $6.91 to $7.05, with revenue growth fairly small, between 2 to 4%. In terms of their news, they are up around 3 to 4% today with the market just open. In terms of over the last year, up only 9%. Over the last 10 years, up around 92%. They have underperformed the S&P, trading in the midpoint right now of the 52-week range, with Wall Street giving this company a buy rating, and we can see they do currently offer a yield of around 2.5%. In terms of their earnings, it does look good when we see green right across the board, meaning they anticipate growth, although fairly marginal, over the next 4 quarters, with a 100% track record. And if we look to June this year and the EPS target, that does give their forward P right now just marginally above 23, which is lower than the S&P's 25. If we compare it though, it is at a premium against the sector median. In fact, you are paying 44% more, but if we actually compare it to their 5-year average, it does come in slightly under by around 5%. And based on dividend yield theory, given the yield isn't far off the 5-year, this is a reasonable signal. And we also note here, given the forward P of 23 slightly below the 5-year, a marginal undervaluation signal. But ultimately, when we do run it through the valuation at $181, it is just the average of these 3 models. We can in fact see at a 10% margin of safety, you would need to wait for $163. So right now, Procter Gamble sitting somewhere between 5 to 10%. With Wall Street, their buy rating, they see this company at $190 at the end of the year, which does translate to 14% upside. We then move on to Dividend King Johnson & Johnson that actually beat on their quarterly sales as well as their profit estimates, and that is a very good sign. We have had some struggles with this company, especially in terms of their share price, and we can see they expect their 2025 sales to come in around 91 to 92 billion and the EPS around 1075 to 1095. Analysts were pretty much expecting something similar, although on the earnings per share, they are anticipating a little bit higher than what the market wanted to see. In terms of the actual sales though, it is nice to see above inflation up around 5.3%, and one of the drivers of their revenue from this latest quarter is their cancer drugs up 19% worldwide, driven by more than 3 billion for multiple treatments, as we can see. We can see right now it is down around 4% on the earnings. Over the last year, down 12%. Over the last 10 years, negative 39%, trading pretty much near its 52-week low, with a double buy rating from both Seeking Alpha as well as Wall Street, and a fairly attractive starting yield for this Dividend King at 3.37%. If we were to take a look at their earnings, again, understand they are expecting some decreases over the next few quarters. Over the last 4, though, they have continued with that beat upon beat 100% track record. And December 2025, with the EPS estimate, it does give their forward P right now just below 14. And if we were to compare that, significantly lower than the sector of 21, meaning you are getting a 30% discount, but also significantly lower than their 5-year average of around 10%. And we can show you on a graphical basis severe undervaluation, both the yield above the 5-year, the forward P as well, 14.8, below the 5-year 16.4. So that is what we would say as a double severe undervaluation. And when we look at our intrinsic value at $174, we can in fact see a fairly decent margin of safety at 15%, a buy at 148. We can see if it comes around $140, you are getting a 20% MOS, but right now at least 15%, with Wall Street themselves seeing 22% upside, their price target of $174, and this might be the most obvious buy out of the 4 that we have run through today, and we will continue to look at earnings as they come through, not just this week, but also the next few months. Also, don't forget to sign up to the free weekly newsletter. We are dropping one every single Monday. Grab those spreadsheets, and also come and join us in the Patreon where we do cover our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.